Hi, my name is Fulton Abraham Sanchez. I am the CPA of the firm FACPM Consultants, and today we're going to speak about how to select an entity type for real estate investment. There is a case for the entity types for real estate investments. The different types of entities between LLCs, S Corp, and C Corps is determinant for the type of tax planning that you will have, and at the same time for the tax consequences that you will have in your individual tax return. So, for example, an LLC and the S Corp are typical pass-through entities. It means that the profits of the LLC and the S Corporation, they are passed through to the owners of the company. This could be partners or stockholders, and those profits will be taxable at the individual tax rates. This could be between 10 and 35% depending on the income level. This is for LLC and S Corp pass-through profits. In the case of the C Corp, there is no pass-through. Profits of the C Corp, they are taxed at company tax rate. The new tax reform created individual 21% tax return for the profits of the company. Now, if the profits of this company are distributed, they become dividends. And for qualified dividends, the maximum tax rate is 23.8%. Qualified dividends are dividends that are kept over 60 days, the profits of the company over 60 days, and after 60 days are distributed. But usually as real estate investments, whenever they are selected as C Corp for real estate investment, they are kept for many years, so they are qualified dividends. And as qualified dividends, the maximum rate is 23.8%. Now, within this 23.8%, remember these are dividends from the profits of the C Corp. 21% the C Corp pays in company tax rate, but when the profits are distributed to the individual partners or shareholders in this case for a C Corp, then they become qualified dividends, and the maximum tax rate is 23.8%. These qualified dividends is 23.8% is composed of 20% maximum rate for capital gains and 3.8% for net investment income tax, but that is when the individuals have over $250,000, for example, for income levels for married couples filing jointly. In the case of principles for an entity selection, a rental income is the LLC is the entity type of choice. For flipping, it's better to put it in a C Corp. And the reason for an LLC being rental and flipping the C Corp is, for example, flipping is an active business, different from rental. Rental is a passive business, meaning that you don't have to work for receiving your rental income from your tenants. In the case of a flipping, you have to at least supervise the work and being involved actively in the business. Therefore, the IRS considers that active business, active incomes, in difference from the rental income that is passive. So flipping is an active business. Therefore, if you use flipping activity with an LLC, you will end up paying self-employment tax 15% in addition to the regular income tax. So better be careful when you are doing flipping and put it in a C Corp, because flipping is not treated as a rental income passive activity. Flipping is an active business, and the property that you are fixing, it becomes part of your inventory. So it's better to plan this before and consult with an experienced tax professional before doing the application for the company. In terms of construction and real estate management, the entity for election is the S Corp. Now, in terms of asset protection, whenever there are assets, real estate assets in a different entity, in a different type of entity, the idea is to protect the assets. We have seen some investors, they prefer to put all the assets in one company, or group many real estate assets in one company, or divide the different properties into separate entities. Independent of the structure of protection, you will need an asset protection umbrella, and the idea is that asset protection structure you create a land trust, and then the land trust per property will be beneficiary for the different entities that you have. If you have selected an LLC, you will see the beneficiary will be the LLC or the S corp or the C corp. But remember, this is if you have your investment in any vehicle entity type. This is for an additional layer of protection as an asset protection. Create a land trust per property, and then make those different land trusts beneficiary of the entity where you have the investments. In terms of reporting, then as we all know, and we have recently made a video about this, there is a 20% deduction from the profits, from the pass-through profits of the LLC and S corp. This 20% deduction is taken at the individual level from the partners for the LLC or from the shareholders for the C corp. The only thing is that there are some income limitations. For example, if for couples, the married filing jointly, the maximum amount to take of income to take this 20% deduction is $415,000. In addition to that, whenever you select the entity type, either an LLC, C corp, or S corp, you have to be very careful because a C corp, for example, doesn't qualify for the 20%, 199 20% deduction for is not valid for a C corp. There is no 20% deduction for a C corp because a C corp there is no pass through. The C corp goes directly pay taxes on the profits of the company. Now, another way also to reduce or defer the taxes is the selection of the accounting method. But you have to be very careful here. There's a chance when you file the first time your tax return, if you elected a accounting method cash, it means that you will be reporting only whatever you receive in cash and whatever you paid in cash as well. But this has to be selected from the beginning to be reported then as a cash accounting, as a method of accounting cash. If you want to change, you will have to require to the IRS a change and explain why you want to change your method of accounting. Another very important aspect is of reporting is the partner base. The partner base is critical because it accumulates the profits of the business, profit plus contributions plus investments from previous periods. So if you have from previous company profits in years, past years, you accumulate a positive partner base, and in the current year of reporting you have a loss. Because you have a loss and you have this positive base, your positive base of investment in the company as a positive, then you will be able to use the loss and deduct that from your income and pay less taxes. We have seen returns that, for example, when they first-time clients, when they come, that the partner base is zero, meaning that even though they have a partner base positive and the company produces a loss, they will not be able to take the loss because a zero base or a negative base, and in this case it will be zero base because it has not been reported, even though they have a positive capital base or partner base, they report a zero or they leave it blank. If there is a loss in the year of reporting, the tax return in the year of reporting, the tax return, the loss will not be able to be taken. It will not be deductible, and you will end up paying more taxes. So it's critical that whenever there is a reporting of the partner base, it has to be reported every year accordingly. If you have questions about these topics, you can check the reproduction list here in our YouTube channel. You can also subscribe if you want to receive more videos, and send us an email if you have a specific question. Click on the link, Fast CPA Consultants, in the description box. Thank you.